Raoul, how long is this going to last?
I have no idea. I'm looking.
How are we supposed to think?
Yeah, we know the game. It's a long-term game. I was looking at the charts of Bitcoin, and it either kind of bases around these levels, or that wedge that you're looking at breaks lower, and before you know it, we go back to the 250-week exponential moving average, which is 22,500. I don't know.
Wow. So you're thinking that 22,500 could be in play?
It could be, as you and I were talking about off camera. If this is 2018 again, that's pretty much what it would do. It'd have another sharp spike lower to hit that 250-week moving average. I don't really know. I thought that it should be basing. What's really interesting, you've thrown 8% inflation, you've thrown war, you've thrown 6.5 or 7 rate hikes priced in, you've thrown everything at it, and the market's not made new lows. That's a positive, but maybe that's just a false hope. Who the hell knows? Well, the problem is Bitcoin, unlike gold, has two qualities. One is the store of value quality, and the other is the growth quality. What can the network be used for, the new technology, and those things are always interplaying. So this is why you see this kind of schizophrenic nature of Bitcoin and crypto overall, is it shifts narrative. So it's not correlated all the time. So we have passing correlations as opposed to total correlations. So over a longer time period, I wrote a tweet about this, over a longer time period, there is very little correlation over anything. Over short-term correlations, over short-term time periods, you've got correlations with all sorts of things. I spent a long time looking at what is the predominant driver of price of crypto, and I came up with the fact that it's the amount of volume kind of multiplied by the number of wallets. And that is a good fit for pretty much everything, number of active wallets. So we need, for the price to increase, we either need daily volumes to increase or the number of active addresses to increase. Right now, we've got neither. So we got to think, okay, how will we drive that? We either do it from further retail participation, but in an inflationary environment where real wages are negative, it's difficult. So therefore, it would have to be institutional. Now, as I've said to you on the show before, I spent all day speaking to institutions, and pretty much everybody is they went last year to get approvals. They've now started getting approvals. They're now trying to figure out how the hell to do it. And so don't forget, 32 billion last year went into VC because they couldn't put it on their balance sheets, and it's easy to do VC. So that tells you there's pent-up demand from institutions, but the reality is they just don't want to own Bitcoin on their balance sheet. One of the things I've done on the side is built a fund of funds business that invests in crypto hedge funds, because you need institutional product right now. There's no institutional product. They're not going to use the ETFs because they're all futures based. The macro markets are actually quite difficult to trade right now. The dollar feels like it's going higher, but I think it's not going to be in a straight line. Bond yields, I think, will probably top out somewhere between here and 225 in the 10-year bonds, but we're kind of still a bit in no man's land. We sold off, didn't really stick in terms of yields. It's not an easy place, but I'm trying to sit patiently. I'm long a bit of bonds, long a bit of gold, and long crypto, and long some dollars, and just kind of waiting to see. I don't think it's the time to take aggressive bets yet. The issue is, Ran, is 2020 is not a good example because it was a 2-month recession and it was met by the largest stimulus the world has ever seen. So you need to go back and look at 2008 and 2001-2 and look at how long a bear market lasts if there's a recession and how deep it was. In those cases, they're generally 50% downside and they tend to be 18 months long.
Okay, so you're saying...
So we don't know where we really are in this situation. Don't forget, the reaction function of central banks has changed now. So they tend to be faster on the trigger, but this one's different because we've got high inflation. So there's a lot of unknowns for all of us in this. We don't know their reaction function well enough yet. So what happens when growth contracts and the price of collateral falls or leverage contracts, it exposes the weakest hands. So that's why we saw those situations. If we had a full recession now, what would be the thing that blew up? Probably nothing. And the reason being is the central banks don't want the collateral to go bust because leverage is too high. So we saw them already in 2020 buying credit. That was them saying we can't allow that to go bust, even though a healthy cycle is weak borrowers should go bust, but they can't allow it. It's too much leverage. So it's a really different world. It's a bigger game than that. This is geopolitics. It's a much bigger game, and this has been played out over decades. So, you know, you need to figure out in game theory who's trying to get the advantage over whom. You know, I don't think much of what's happened will have been a shock to anybody involved. In terms of, you know, the Russians kind of would have expected this, and everybody's trying to push it for their advantage. You know, maybe the advantage is to weaken Europe as a whole or NATO as a whole. Maybe the US has an advantage now that it can become the predominant energy player by pushing Russia out of the market. You know, these games are ugly in geopolitics. If you ever read the book, The Confessions of an Economic Hitman, I got about 2/3 of the way through it and I put it down and thought, I don't want to know this stuff. It's so ugly that it's just not nice, and you'd rather not be involved. And the other thing is none of us know. So it's just conjecture. We can sit here all day and pretend we know, but we don't. I haven't changed at all. I haven't taken a penny out. You know, the riskier end of the curve, you know, I had thematic strategies. So I had DeFi, I had some metaverse, I had some layer 2, some layer 1s, but mainly, you know, it's 80% ETH. And, you know, the riskier end of the curve got killed. Some of the metaverse stocks did pretty well in a bear market for a period of time. You know, it's like, for me, that's fine. And only so therefore, if I think of the risky side of the market, I took a small amount of risk in that. You know, I then topped up with ETH calls because that was I thought we had a decent probability chance of an upside break at the back end of last year. Didn't happen. So lost the money in the calls.
Expired worthless, yeah.
Expired worthless. Well, haven't expired yet. If ETH gets to about 15,000 by 2 weeks, I'll be in the money. So, you know, and that's fine for me. So really what I've been doing is looking to allocate more over time slowly, because this is not a market I try and time, because I'm not really interested in that. And, you know, I'm not a shorter term guy. So I'm looking where to allocate and how to allocate. I'm still struggling to find a better bet than ETH as a risk-adjusted reward over, give it a 12-month time horizon. The changes to ETH coming, that's all coming by the summer. I think also we're going to get the Bitcoin ETF, the spot one out. From what I'm hearing through back channels, that there's at least 2, maybe 3 that are going to get approved, and that's April. So, you know, now that doesn't mean that people rush into that because Bitcoin's going down, so why would they? But at the margin, these are positive news flows. Yeah, April, May. But April there's at least 2 in April with Bitwise and another one. You know, we're getting very close. And, you know, Gensler's statement this week or last week, whenever it was, I've lost track, was very positive for this kind of stuff, which is, we get it, it's here, it's not going away, we'll regulate it carefully. It's just all the right steps. If you launch a product in a down market, why is that suddenly going to be, oh my God, let's rush in? Right? Humans are, you know, behavioral creatures, and so it just facilitates a bull market. But I doubt it turns around a bear market, because it makes no difference, because retail already own the stuff, and institutions, they tend to prefer. We might get more allocation, a bit more allocation, but they tend to prefer to see the price turn around. Also, The other one that interests me is look, DeFi is not going away. Most of DeFi is down 75% or so. I don't know whether what's in existence now in DeFi has a killer application, but, you know, my guess is if you're looking to allocate further out the risk curve, a DeFi basket at some point down this much gets kind of interesting to me, because, you know, DeFi is not going away, and it's going to be a much larger part of the world as we know it in the future. I personally can't choose what's going to win out of this, so I tend to do these things as just buying an equally weighted basket of stuff and see what happens. So I tend to look at, okay, where is the next big wave? I try and live a couple of years in the future in almost everything that I do. And for me, the big thing is the applications layer. You know, it is DeFi and the next iteration of that becomes more usable for the average person, and it's unusable for the ordinary person. So that's going to come, and that's going to be huge. I think, as Tasha mentioned social tokens. They're coming. I know they are, because I'm working on a bunch of projects based around this, and these things are enormous, but people just don't know it yet because they haven't seen it. So all of that's coming. The applications layer around NFTs has only just started. It's very frothy right now, pulls back. So I'm actually focused on that. As I said, I'm building two businesses. One is actually tokenizing the world's largest communities, particularly cultural communities, music, sports, and music, sports, and fashion. And the other business is a fund of funds to give access, which is what we need to do. We need to give institutions access because they haven't got it.